Well, welcome. And this is going to be an exciting discussion tonight. I'm Chris Farrell, and it is my pleasure to welcome you here on behalf of the Heller-Hurwicz Economics Institute. And the mission of the Heller-Hurwicz Economics Institute is to build a bridge between leading-edge economic research that happens here at the University of Minnesota and business leaders, policymakers, community members, government officials, people like me, students, who can benefit from that research. And the Institute fulfills its mission through events like this, as well as other public focused communications, including the Office Hours podcast, which I host, and also investing in rigorous research done by top University of Minnesota economists and students, all with the goal of influencing real-world economic policy decisions that promote the public good. So I'm excited to welcome you to this event, which promises to be a very engaging conversation. As we were talking earlier, it's also extremely timely right now in France, for example. If you've been following the news, there's a huge debate that has emerged about whether or not to adopt a wealth tax. And we're joined in the audience here, economists, policymakers, journalists, students, faculty, and others interested in understanding economic issues. And I would like to extend a special welcome to members of the Heller-Hurwicz Economics Institute board who are here tonight and provide critical support to help advance the Institute's mission. And thank you to Litigation Analytics for co-sponsoring this event, and your support makes events like this possible. Along with those of you in the room, we also have many guests turning in online, and thank you all for being here. So our presentation tonight features Dr. Florian Scheuer. Florian Scheuer is the UBS Professor of Economics of Institutions at the University of Zurich. He was previously on the faculty at Stanford University, held visiting positions at Harvard and UC Berkeley, and was a national fellow at the Hoover Institution. He obtained his PhD in economics from MIT in 2010. His research centers on the policy implications of rising inequality with a focus on tax policy. His work has been published in the American Economic Review, the Journal of Political Economy, the Quarterly Journal of Economics, and the Review of Economic Studies, among other journals. Our other speaker will be Dr. Kjetil Storesletten. Kjetil Storesletten is the director of the Heller-Hurwicz Economics Institute and the Richard and Beverly Fink Professor of Economics at the University of Minnesota and a fellow of the Econometric Society. He has previously held positions at the University of Oslo, Federal Reserve Bank in Minneapolis, and the Institute for International Economic Studies. He has served as a member of the Executive Monetary Policy Committee of Norway and as president of the European Economic Association. Kjetil received his PhD in economics from Carnegie Mellon University in 1995. He's a macroeconomic economist with a special focus on inequality, taxation, and development economics. His work has appeared in top journals in economics, including the Quarterly Journal of Economics, Journal of Political Economy, American Economic Review, and Econometrica. So please join us in welcoming our speakers. And first, we're going to turn it over to Kjetil, and then we'll go to Florian, please. And you need.
Thank you very much. Bring the slides up here. All right. Should the United States introduce wealth taxation? When thinking about that issue, we have to take a step back. Why do we tax? Well, there are three reasons. The number one is a bit obvious one. We need to raise money for some. There's some stuff the government would like to spend money on. We need to raise that money through taxation. At the federal level, at the moment, we're spending much more than we're collecting in taxes. So there is a desperate need for either increasing the taxes or reducing the spending, or both. At the state level, there is a balanced budget. But looking forward, the spending needs are going to go up. So in all likelihood, there's going to be a need. States are going to be looking for sources of taxation for the future. In terms of redistribution, we've seen a big rise in inequality in the United States and many other countries over the last decades. Perhaps the rise in inequality should be accompanied by larger tax progressivity. That could be. even though the tax and transfer system in the United States is progressive, the people have argued that perhaps for the very richest, the tax rates are not as high as some people would like. Anyway, there are also other aims for taxation, for example, to affect, to reduce pollution, discourage smoking, etc., etc. I'm not going to talk so much about that. But what we would say is a good tax system? A good tax system achieves those goals without shrinking the pie too much. Okay, so that's what we're looking for when thinking about whether we should do it. Now, could a wealth tax improve that tax system? As it turns out, a number of countries have a wealth tax, but over the last decades, the trend has been to abolish the wealth tax. So at the moment, it's basically Norway and Switzerland, the countries that still stick to the wealth tax. Now, wealth tax is back on the agenda. Thomas Piketty, for example, have argued for a long time that we need to introduce a global wealth tax to reduce inequality, and a number of countries with shrinking budgets are thinking, oh, perhaps that might be something we haven't thought about. Perhaps we should return to that tax in order to raise in order to get back some tax revenue. Let me just do something, just to clarify things a bit. In terms of taxes on capital, how do we tax capital in the United States? We tax capital on the one hand by taxing households, on the other hand by taxing firms. In terms of households, you get the tax on capital gains and dividends. The tax rate is almost 24% at the maximum. You taxed, if you have interest, rental income, royalties, and pass-through to firms, that taxed at the maximum rate of 37%. All of this, state and local taxes come on top of that. If you tax through your estate, you tax, the maximum tax rate is 40%. But there is a gigantic deductible. So that most people don't. Tax is in most cases irrelevant. Then there is zero tax on wealth and unrealized capital gains. Taxing wealth and unrealized capital gains is two sides of the same coin. In terms of firms, there are corporate income taxes, and then there are also a bunch of production taxes. Property taxes, sales taxes, excise taxes, etc., that firms pay, that are mostly at the state and local level. Now, the classic view in public finance is that corporate taxes are bad, dividend taxes are good. And where does that view come from? Well, imagine you have a perfect world. So capital markets are perfect and there are no tax loopholes. In that case, you could tax corporate taxes. So corporate tax means that the firm has some profits and then you tax those profits directly. The problem is that if you tax the profits of the firm, then it's optimal for the capitalist to have a little less capital in the firm. There are a bunch of investments you don't fund. You only finance the best investments. So you reduce the amount of capital in the firms, and that we think will also reduce in the over time the wages that they pay. So that sounds like a bad thing. What about dividend taxes? Well, dividend tax, the firm may have some profits, and so as long as the money stays in the firm, they're not taxed. It's when they're paid to the owner that they're taxed. See, that's brilliant, because that doesn't. Then the capitalist doesn't want to have too little capital in the firm. Then you have the right amount of capital in the firm. That should, in principle, solve all the problems. Although there still remains, it will still be a distortion in terms of creation of new firms, because when you inject equity the first time, it's like it's still distorted. Let's not worry about that for a second. Now, a wealth tax in this world, in this perfect world, a wealth tax is approximately equivalent to a dividend tax. So the conclusions are if the world were perfect, dividend taxes are better than corporate taxes. And it doesn't really, whether we have a wealth tax or dividend tax, it doesn't really matter. There will be two different ways of taxing the same thing. And indeed, that view has had a lot of policy influence because a number of countries over the years, a number of countries have tended to reduce the corporate tax rates and increase the dividend tax. And I think Norway is a prime example where the corporate tax went from almost 40% down to 28 and now 21%. So the corporate tax is cut in half over the years, and the dividend tax has increased to 48%, which is pretty large if you think about it. So when they after Norway did that in 2006, something strange started to happen, at least to the policymakers. The firms stopped paying dividends, and they were just accumulating this wealth within the firms. And then now, 20 years after, or 19 years after the policy reform, politicians are very worried. They're saying, "Oh, look, the firms are not paying. They are skirting the taxes." And the capitalists say, "No. When we pay the dividends, we still have to pay the high dividend tax." So why is it that why would the capitalists do that? Why would they want to hold why would they want to, we call it retained earnings? Why would they like to retain the earnings instead of paying them as dividends? Well, one reason could be that the plan is to collect a bunch of, retain a bunch of earnings. So you have an implicit tax debt in the firm, and then you move abroad. And then you pay the dividends to yourself. It turns out, as I'll show later, Norwegians did that in droves. All right, so so then the government in, I think, 2015 or something, the government said, "Oh, fine, we closed that loophole." So they introduced an exit tax. Next, perhaps the capitalists, they imagine you want to give the firm, you plan to give a bequest. So you could have the firm and pay dividends to yourself, pay tax on that, and give the money to your children. But a much better idea is to not pay the dividends. Just have the dividends, have the retained earnings in the firm, and then give the firm to your children. And then the way it used to be is the same as it is in the US, that there is a so-called step up. That when you do that, the tax debt is canceled. So the children can not pay that tax debt. So that's a way to, then the politicians closed that loophole too a couple of years ago. Or perhaps the owners are just waiting. They're waiting for a so-called tax holiday. They're waiting for one day in the future. It's going to be a government friendly to them that's going to set low dividend taxes. And they just wait. And then when that low dividend tax, they pay everything out. Okay, suppose that's the case. Well, in that case, it could be, by the way, is that a problem? Well, it would be a problem if you want to raise a certain amount of revenue from the capitalist. You would have to have very high dividend taxes then in order to get that revenue. Or it's also a problem in the sense that perhaps capital don't flow to the right firms. How could we prevent such tax avoidance? Well, the obvious answer, of course, is to close the loopholes. But you could also, in that case, a wealth tax could help in terms of reducing the incentives to engage in that kind of thing. All right. Imagine we introduce a wealth tax. What's the problem? Well, an obvious problem is that when you have a wealth tax, that would reduce perhaps the savings of people, and it could also make people induce people to move. And we'll look at the data later and see that especially the second issue is a big problem empirically. It's also a problem with empirical implementation. When we tax wages or your earnings, it's very easy because your employer has a W-2, it writes to IRS how much it paid to you and to you, and then on your tax return, that's easier to measure how much you earned. and it's easy to measure in terms of wealth. It's easy to measure the value of how much you have in the bank when you deposit, or how much your stocks that are traded on the stock exchange. Easy to know how much they are worth. Not so easy to know how much your firm is worth. So in practice, the way it's done is that certainly in Norway and Switzerland, your wealth is the so-called book value of capital in the firm. All right. So the book value, it means basically when you make an investment in the firm, you buy a machine that enters into the book value, and over time it depreciates. So so basically the value of the capital you bought. So think now about a firm. Imagine you have a firm that's not doing particularly well, losing money. So the value of the firm is very low, but the capital, it's the book value. So that's how you tax. So that means that firm, if me and Anmol, for example, we're on two different firms, we invest the same amount. My firm is not doing well. Anmol's firm is doing fantastic. So his firm is worth a lot. The true value is high. Mine is low, but the book value of capital is the same. Then we have to pay the same amount in wealth tax. That means that in that sense, a wealth tax it's a harder tax on firms that are not doing so well. So it redistributes from bad capitalists to good capitalists in some sense. So a governor, for example, argues that that's a good thing. But the problem is that it's not very attractive to take this. The moment you take the firm public, the value of the firm then now becomes the stock market value. So that means, of course, that you don't do that. So if you look at, for example, the stock exchange in Norway and compare it to the stock exchange in countries that similar countries that don't have wealth tax, Denmark, Sweden, Finland, you see that in Denmark, Sweden, Finland, lots of young firms traded on the stock exchange. In Norway, zero. Why? Well, because you don't go public in Norway. The moment first you delay going public, and when you do, you go public in the US. All right, let me skip risk taking. Now, what about empirical evidence? Most of the empirical evidence are focused on the effects on savings and wealth, and on the effect of migration. So there is, surprise, a large dispersion in the results all over the place. But let me try to summarize what I think is the consensus. When you look at local wealth taxes, the effects are huge. So for example, if you look at different cantons in Switzerland, they have different wealth taxes. It turns out that if you increase the tax a little in one canton, the wealth of people there falls like a rock. Unsurprising, because you can just move 2 kilometers and then you can have more or less the same life and avoid the tax. Similar results hold true if you look at Norway. So, for example, in Norway there was a couple of municipalities that abolished. There was a wealth tax on 1%, and a couple of municipalities took away that, and the amount of wealth increased enormously there. And most of those effects are due to migration. That people with wealth they move away from places where there is high tax. On the nation level, the effects are smaller but still sizable. So imagine the whole nation changes the tax, wealth tax, and that if you look at Sweden, for example, when Sweden abolished the wealth tax, if you look at people with low or moderate wealth levels, the effect of the wealth tax is very small. But if you look at the rich, the effects are much larger. So to really learn something from that, we need data for big changes and where we have good data. So Denmark presents such a case. So the country in the world that had the highest wealth tax is probably Denmark. In the 80s, the wealth tax was 2.2%. Think about that. 2.2% wealth tax. It's pretty large. And then over a 10-year period, they reduced that to 0. So, and what is beautiful is that when they did that change, they did it in a way, that allows us to learn. The tax was not changed in the same way for everyone. So that allows us to use kind of empirical methods to learn something about because you can look at people who are strongly affected by reform, people who are not affected, and what we learn from that is that that for the rich you get really large effects on total wealth. After 8 years, the wealth of the richest increased by about 30%. So I want to say, so in critique against many forms of research is often that, oh, perhaps it's politically biased, etc., etc. This paper is, I challenge you to argue that this. Let me not go there. I think you should believe that that's a lower bound of what the effect is. Now, why is the effect on wealth so large? An important reason is migration. So, Clem et al. At Princeton studied tax reform in Norway and found that when you lower the tax rate on wealth by 1 percentage point and look at the richest share of the population, the number of people fall by 2%. An enormous effect. And you can, if you open the newspapers in Norway, you just read about it all the time. So-and-so person have been moving. So wealth taxes have large effect on migration for the rich. Now, should the U.S. introduce a wealth tax? I think to have a wealth tax at the state and local level would be crazy, because that could expect to have very large effects on migration and local wealth, and a federal tax, I think, could be expected to have a relatively small effect on migration and savings, and could perhaps mitigate some of the issues with terms of the critique against using the dividend tax. But introducing a new tax is a heavy lift in terms of getting to Congress. Are there some alternative policy reforms we could do if we want to A, achieve redistribution by taxing the rich more, and B, raise revenue? Yeah, I think the obvious thing for the United States to do is to close the loophole that's associated with a step up. So step up means that you adjust the cost basis of inherited assets to market value when it's inherited by the heir and the owner dies. So that eliminates basically the tax debt when it's passed to the heir. The second, if you really want to raise a lot of tax revenue, the only way to do that is to have a federal sales tax. With that, I'm going to leave the word to the next speaker.
Thank you so much. Thank you, Kjetil, in particular for the invitation. It's great to be here in Minnesota, which is a very special place for economics. And it's particular fun to do this with Kjetil because of his enthusiasm that you just saw, but also because I admire his work. And in fact, he's been a big supporter also of my own department in Zurich as an advisory board member. So thank you for that as well. Let me start with this graph from a book by Piketty and by Sayers and Zuckman a few years ago that actually made some splash, which computed the average tax rate of different percentiles of the income distribution in the US for 2 years, from the 1950s and for 2018, a year before the book came out. And what you can see from these numbers is that whereas the US used to have a very progressive tax system with increasing average tax rates, more recently it looks more like a flat tax, so an erosion of progressivity. And I don't want to suggest that this is uncontroversial, so there's a lot of discussion about these numbers, both at the bottom end and the top end. In fact, it's currently a very active research area to really compute these average tax rates at the top end. And why is there quite some controversy about this? Well, this is not numbers that you can read off some statistics, some tax returns, but actually there's a lot of assumptions going into this, because what they try to do is to compute the total average tax rate that different people are paying, and that includes, for instance, indirect taxes like sales taxes, transfers, the corporate tax, which then depends on what you assume about the incidence of the corporate tax. But perhaps the feature of this graph that made the most splash was that the billionaires, you know, if you look at the top 400 here, the Forbes 400, those are all billionaires. The 400 richest Americans pay the lowest average tax rate. And there was a report recently by the White House, Danny Yeagan and Greg Lazarson, White House of the previous administration, that in fact computed that the tax rate on the Forbes 400 is only, the average tax rate is only about 8%. And most recently, just 2 weeks ago, a new paper came out that argued that this average tax rate of US billionaires is 24%. So there's quite some uncertainty, as you can see, about this. And I just saw the program for the fall meetings of the NBR Public Economics Group come out. And there's, in fact, 3 papers that estimate the average tax rate on billionaires. And they all come to different numbers. They all use different approaches, but they all find numbers that are certainly smaller than the statutory top marginal income tax rate that we have in the US, which is about 40%. So we do have a progressive statutory income tax schedule, but it seems that at the very top end, people are not paying that as the average tax, whereas you would think that if you're very rich in terms of your income, you're deep in the top marginal tax bracket, your average tax rate should kind of approximate the top marginal tax rate. That's not happening. So what's the reason for that? Why don't we see that? The fundamental reason for that has to do with the form of income that billionaires have, which is not labor income like you and me, but it is mostly capital gains. This is from a recent paper I've written with Joel, where we compute the share of total income that is in the form of realized capital gains in the US, again, for different parts of the income distribution. You see that for most people, capital gains are negligible, right? We have mostly labor income. But as you zoom in the very top of the distribution, it becomes incredibly important. For instance, again, for the top 400, it's more than half of their income is in the form of capital gains. And many of these people are successful business founders. Think of a person like Jeff Bezos. Amazon doesn't pay dividends, in fact. He doesn't pay himself a wage. So the only form of personal income tax he would pay is if he sells some Amazon shares and realizes the associated gains, so pays capital gains tax. And then on top of it, of course, he pays corporate income tax to the degree that the incidence is on the shareholders. Now with Amazon, again, we don't quite know how much corporate tax they in fact pay, because they try to book their profits in tax havens. But even if you're sort of optimistic, the average corporate tax rate of US corporations is about 17%. And if you assume that's all the incidence is on the shareholders, you know, you get an average tax rate close to 16%, as long as he's not selling a lot of his shares. And so that has led to some unhappiness with the current tax system. You know, the very rich have their income concentrated in these capital gains, and there is a benefit to having your income in capital gains from a tax perspective for these 3 reasons. First, It's only taxed on realizations, as I just mentioned, so you can delay that tax burden for a long time. It's taxed at a lower rate than the statutory income tax rate, 20% instead of roughly 40%. And then most importantly, as Kjetil already mentioned, if you never realize during your lifetime, you bequeath these assets, then all these lifetime capital gains completely escape taxation. And in fact, there are estimates both from Norway, because they had this reform where they got rid of the step up in basis, and also calculations for the US that estimate that roughly a third to half of all capital gains, in fact, never get taxed purely because of this step up in basis provision. And so we've seen these reform proposals to react to that. So the Biden administration and also Kamala Harris, as a presidential candidate, had in their tax plan actually a tax on accrued capital gains, where you'd have to tax your unrealized gains. You would get rid of the realization-based system. That, of course, would change this. You know, then a person like Jeff Bezos would have to pay taxes whenever Amazon stock increases. Or the prominent wealth tax proposals that you know, Piketty and Warren and Sanders have come up with, and is currently very hotly debated in France as the so-called Zuckman tax. In fact, this is not just a recent policy idea, it's an old idea in public finance. Some of us are teaching public finance. We teach these old concepts. When in the 1930s, economists thought about what is the right basis for the income tax, these economists, Haig and Simons, came up with this concept of the comprehensive income tax, which basically said the right basis for the income tax is consumption plus the change in wealth, which comes from this intuitive notion that, you know, the total flow of resources that has come to you over the course of a year, say, either must have gone into your consumption or your savings. So that's the total, that's how we should compute the total income. And if you think about change in wealth, that of course includes unrealized gains. So Haig-Simons, this classic Haig-Simons income concept, would actually prescribe the taxation of unrealized gains, which an accrual-based capital gains tax and a wealth tax would achieve in an indirect way. So I promised to talk a little bit about the Swiss wealth tax when we prepared for this event, because as Kjetil mentioned, there used to be about 12 OECD countries that had wealth taxes in the 1990s. They all got rid of them. Sweden, Denmark, Netherlands, Germany had a wealth tax. And now there's only 3, Spain, Norway, and Switzerland. But I would say only the Swiss wealth tax is really generating revenue to a significant degree. I mean, Spain is raising negligible revenue with its wealth tax. And Norway is raising some revenue, but still Switzerland raises 3 times more revenue as a percentage of GDP than Norway with its wealth tax. So it's the biggest wealth tax that we currently have. And a lot of colleagues ask me, how do you guys actually do it in Switzerland? So I was thinking of telling you a little bit, being from Switzerland. So the Swiss wealth tax is a cantonal tax. There's no national wealth tax. So the cantons have a lot of leeway over how they design this tax. And in fact, we have a 3-tiered tax system in Switzerland. We have the federal tax, the cantonal tax, and then even municipal tax. So municipalities can also set their tax rates. And so what I'm plotting here is the total top marginal wealth tax rate in the main cities and the capitals of each canton, if you add both the cantonal and the municipal tax rate. And what you can see, there's a tremendous heterogeneity across these cantons, depending on where you live, what the top marginal wealth tax rate is. Geneva traditionally has the highest top wealth tax rates with more than 1.1%. But it goes all the way down to the canton of Nidwalden, which has an 0.1% top wealth tax. And in fact, nowadays, about half of the cantons, I think more than half of the cantons, have a top marginal wealth tax rate less than 0.5%. The Swiss wealth tax is not very progressive, in contrast to the recent proposals like the Zuckman tax, which really targets millionaires and billionaires. It is paid by a large fraction of the population. So there's an exemption amount below which you don't have to pay wealth tax, but it's not very high. So it ranges, again, across cantons between about 50 100,000 Swiss francs and 250,000 Swiss francs. And if you have more wealth than that, you start paying wealth tax. Not very high, but many people actually pay some wealth tax. And the base of the Swiss wealth tax is just like we economists would like, conditional on having a wealth tax. It is a very broad base. It's essentially all assets are included in wealth tax base. The only exception is if you have real estate abroad, that's not included, but everything else is part of the wealth tax. Now, is this a good example for other countries? Well, I think for two reasons, essentially, it is hard to infer from the Swiss wealth tax about optimal tax design in other countries. It is very stable. It raises more than 1% of GDP in revenues. And Switzerland is a direct democracy. It is popular. It has survived numerous attacks. We vote about tax policy in referendums. And there's been multiple referendums trying to abolish the wealth tax. They never passed. So the population seems to be on board with it. But it is a bit special because Switzerland does not have a capital gains tax on financial assets. So unlike the US and many other countries, capital gains are completely tax-free. And there is currently no bequest tax for direct descendants. So that used to be cantonal taxes also, but then there was a lot of tax competition, and one canton after the other sort of lowered the bequest tax, and now it's basically zero everywhere. It's a classical race to the bottom story. So from that perspective, the wealth tax is kind of a backstop for these missing tax instruments that many other countries actually use. And then there's two other elements that make the enforcement of the wealth tax limited. The first is that we still have bank secrecy in Switzerland. So Switzerland agreed to exchange information about bank accounts with other countries, mostly based on pressure from the US. So if I have some tax relationship with the US, the Swiss tax authorities would actually send my bank account information on my Swiss bank accounts to the IRS. But the Swiss tax authorities have no way of getting ever any information about my bank account. So that was the compromise, that they would maintain bank secrecy within Switzerland, even though they exchanged all the bank information with the rest of the world. So of course, that limits enforcement. In principle, you could hide bank accounts from the Swiss tax administration. And then second, as Kjetil mentioned, always with the wealth tax, the issue is the valuation of privately held businesses, which is notoriously difficult if you don't have a market price. And it's actually not true. The Swiss don't use the book value. They're a bit smarter than that. They do some capitalization of flow profits with some formulas, but it's a kind of negotiation ultimately between the tax authorities and the owners of these firms on what the valuations are. And typically you settle on something that both sides are happy with and is not going to be litigated. And so that kind of pragmatism leads to a kind of equilibrium where even the rich who own these kind of businesses feel treated rather leniently by the tax authorities. And so they're kind of supportive of this overall equilibrium. Now, one question you might ask, since the Swiss use this wealth tax so extensively to raise revenue, does it actually reduce inequality? Because if that's what we start from, that there is an erosion of progressivity, and we want to use the wealth tax to make sure that there's this backstop, at least for the very rich, then how effective is that? So let's look at the Swiss case. And one thing you can exploit, of course, is this cantonal variation, both in tax rates and inequality. And that's what I'm going to show you here. So over time, we've seen tax competition across cantons in Switzerland as well. So wealth tax rates, top wealth tax rates have come down over time. They used to be on average, those are the top marginal wealth tax rates on average used to be about 0.8%. And now it's less than 0.5% when you take the average across cantons. And in fact, there's quite some heterogeneity across cantons. We can group Swiss cantons into three groups. Essentially, there's a group of cantons that haven't largely changed their top wealth tax rates, including Geneva, with the highest marginal tax rates of 1.1%. Then there's another group that has gradually reduced their wealth tax rates. And then there's a third group that have experimented a bit more with their wealth taxes. That's the rightmost panel here. And that especially in the around 2010 have really drastically cut their wealth tax rate because they've sort of engaged in local tax competition that includes Bern and Lucerne and so forth. At the same time, we can relate this to the development of wealth inequality in Switzerland, which has also risen, just like we've seen in many other countries. So I'm plotting here the top 1% wealth share in blue in Switzerland. And you can see it has risen from about 30% in the 1980s to now more than 40%. Most of that, in fact, has been concentrated at the very top. So the top 0.1% share has, in fact, doubled from around 10% to most recently more than 20%. So really quite some concentration. If you look at the top 0.01%, that is even more extreme, that has tripled from about 4% to 12%. So the very rich have increased their share of wealth, also in Switzerland. And in fact, there's huge cantonal variation. So what we did in this paper, or my co-authors did, we really went into the cantonal archives and looked at what's the wealth inequality within canton. And we were actually surprised how much variation there is across cantons. So here, for instance, you see that the dark red is the canton of Nidwalden, which I already pointed out, it has the lowest marginal wealth tax rate. It's actually one of the cantons where most of the Norwegian billionaires have moved to, that moved from Norway to Switzerland. And you see already in order of magnitude, like the degree of wealth concentration in Nidwalden is just mind-boggling. You know, it used to be around 50%, which is already high in international comparison. Remember that the US top 1% share in the wealth distribution is about 35%, so already 50%. But it has increased over the last few decades to now almost 70% most recently. So that's just the highest even within Switzerland. But there's similar trends if you look at the canton of Schwyz, which is another canton where a lot of very rich people live, including Roger Federer, for instance. Their top 1% wealth share has doubled since 1990s from about 30% to now also 60%. And then by contrast, there's other cantons that have seen a very different trends. For instance, the canton where I live in Zurich has seen essentially a flat trend over the last few decades. The Zurich is the blue line, where it's basically been constant for the last couple of decades, always around 40%. You don't really see a big increase. And there's some other cantons like the canton of Aarau that has a very low concentration of wealth, around 20%, that has recently increased a little bit. That's the blue, bright blue line at the bottom, has increased a little bit, but it's still much lower than in other cantons. Overall, wealth inequality in Switzerland is relatively high even compared to the US. But we were really surprised to see this tremendous degree of heterogeneity. So that raises the national question, is this somehow related to the wealth tax that these different cantons are imposing? Is the wealth tax, in fact, affecting the degree of income concentration in these cantons? And you can use, as you saw, we have these different reforms. You can basically do empirically a staggered difference in difference strategy where you compare cantons who changed their wealth tax and use other cantons who didn't as control groups. And if you do that, you do find very strong effects of the top wealth tax on income concentration. So this is doing it for the top 0.1 share. You see that wealth tax cuts actually increase the top wealth share, and top wealth increases reduce the top wealth share, with quite some dynamic effects over the, roughly 8 years following these reforms. And what we conclude, if you put this all together, is that just the wealth tax cuts that we've seen over the last 50 years explain about a quarter of the total increase in income, in wealth inequality that we've seen in Switzerland during this time. So it's a quarter. It's not everything, clearly. Wealth tax is not the most important driver of wealth inequality. It explains some of it. The other thing that I think has also played a big role is that we got rid of the bequest tax, essentially completely. also feature. And then, of course, there's other trends that have affected, like asset price changes, interest rate policy, that have changed the wealth concentration that are not necessarily related to wealth taxation. Now, let me conclude the last few minutes with talking conceptually about what we've learned from this and what it means for whether and how, if yes, we should tax wealth. Now, the first thing that you could think about is, should we tax wealth? Should we tax capital gains? If you want to restore this progressivity, especially at the very top. And one difference between the two is that if you tax wealth, looking back, one advantage of it is it taxes pre-existing wealth. So it's like a lump sum tax. If you can do it in an unanticipated one-off way, you just surprise people with saying, now there's a one-off wealth tax, then it's a lump sum tax. And of course, that's a big difference to a capital gains tax, which is more forward-looking. And that has often come up in the political debate. You know, even Donald Trump, in fact, when he was a nominee of the Presidential Reform Party in the 1990s, he proposed to do a one-off, what he called net worth tax of 14% on everybody who has more than 10 million, to eliminate the national debt in one swoop. So that was his proposal. I don't think he would still remember. But of course, politically, this is just impossible. You know, it has never happened that you do these one-off unanticipated taxes and then they don't stick around. In fact, many of the taxes we have nowadays started originally as kind of one-off taxes after wars and wars, like including the Swiss wealth tax, and then they just sticked around. So I don't think that's a realistic approach. Now, if you look forward, then wealth taxes and capital gains taxes are actually very similar. If you think of a 2% wealth tax, which is what is discussed right now in France, depending on what the rate of return is that people have on their wealth, say people have a 4% rate of return, then a 2% wealth tax is just the same thing as a 50% capital gains tax. If people have a 2% rate of return, then a 2% wealth tax is like a 100% capital gains tax. And as Kjetil already alluded to, this means that a wealth tax is good for people who have high rates of return, and it's bad for people who have low rates of return, who sit on their capital without any good ideas what to do with it. They have low rates of return, and so then the wealth tax really hits them hard. And Kjetil mentioned the paper by Fatih, but in fact, this idea goes back to Maurice Allais already, Nobel laureate, who already argued that this is really a great thing about the wealth tax, and it would reallocate capital to more productive people. And in fact, Allais proposed that France gets rid of all income taxes, just have a wealth tax, purely for these efficiency reasons. Now, I mean, I see these efficiency arguments in favor of the wealth tax, but what I'm worried about in this comparison, that in practice, in fact, a lot of capital gains is really just reclassified labor income. So think about a startup that you're a founder of a startup, you finish college, you start a startup company with a couple of friends. The startup doesn't have a lot of cash initially, so you can't pay yourself a high wage. Most of the compensation you get as a founder is shares in this company that you're founding. And of course, the hope is that if the company is going well, you have a successful exit, then these shares will be worth much more. So when you sell these shares at an acquisition or IPO, for instance, it will all show up as capital gains on tax returns. But in fact, if you think about it economically, it's really just a compensation of the labor effort that you're putting into the firm as a founder. So this is just reclassified labor income. And first of all, a wealth tax is a unit tax, right? It taxes, you just pay a 2% tax, no matter how your actual rate of return is. So now, if this is all labor income, it's like saying I'm paying a tax on my labor income that is independent of how high my labor income in fact is. It's a unit tax in that sense. And it just doesn't make any sense to tax labor income with the unit tax, right? It makes much more sense to tax labor income with the kind of proportional tax where you say you just have to pay like 30% tax on your labor income. In other words, like a wealth tax kind of taxes the the normal rate of return, as we call it. But not, if you have higher rates of return, it doesn't tax that, what we call excess returns. So if that's coming from variable income, that does not make sense to not tax that. And in fact, if these excess returns come from other reasons, like you have market power, for instance, and we've seen signs of rising market power, then that should be taxed even more, right? So the wealth tax does not accomplish that, whereas the capital gains tax would, in fact, accomplish that. And we think, Joel and I did this when we wrote our paper on taxing our wealth. We think that this shifting of labor income into capital income has become more important over time. If you think about innovators in the 80s or in the 70s, you worked for a big company like IBM. When you patented something, you maybe got a salary raise, but it was all labor income. Now, a lot of that happens in startups. So this income does not actually show up on any tax returns unless there's an exit, and then it only shows up as capital gains. So that's one reason against the wealth tax relative to a capital gains tax. There's another reason that I want to briefly mention, which is that a lot of the capital gains we've seen in the last couple of decades, in fact, come from asset price inflation. So asset prices just have increased, and this is just an illustration of that. The dark blue is the total value of US non-financial corporate businesses, which has increased a lot. And if you think about why asset prices increase, think of a stock. It could increase for two reasons. One is that the profits underlying this stock are increasing. The other is that because the value of the stock is the present discounted value of these future profits, is that the discount rate that you use to discount these profits is decreasing. And so in the bright blue, I'm plotting the profits during the same time, which have increased, but not as much as the asset prices, which already suggests from this simple dichotomy here that part of this increase in asset prices, in fact, comes from lower discount rates, from lower interest rates, which we know, this is a period of time where we've seen a secular decrease in interest rates. Now, if you think about how to tax these kind of passive savings, it's not active accumulation of capital. It's just you have a stock and its price is changing. So we call that passive savings. How should, if at all, how should we tax that? Well, if you think about the welfare effects of such a tax, of such a asset price change. So take a stock that pays $100 of dividends per year, and suppose the discount rate is 10% that you're using to compute the present value. Well, then the stock price should be $1,000. That's the present discounted value of getting $100 forever. Now, suppose the interest rate drops to 5%. Well, you have the same dividend flow, the same profit flow, but this lower discount rate, it doubles the stock price mechanically to $2,000. But if you have an unrealized capital gain of $1,000, your wealth doubles, but it's a paper gain, it's a paper wealth in the sense that if you just hold that stock, your consumption possibilities haven't changed at all. You just get $100 per year in dividends. In fact, when the interest rate is only 5% rather than 10%, you need twice the amount of wealth to get the same, if, for instance, if you want to save for retirement to get a constant flow of income during retirement, you need twice the amount of wealth to get the same flow of financing for your consumption. So in welfare terms, you haven't gotten richer at all if you just hold. Of course, if you want to sell, then you benefit from this higher asset price. If you want to buy, so if interest rates come down and house prices double because of lower interest rates, and you want to buy a house, you don't have a house yet, then that's bad for you. So the buyers lose, the sellers gain, and those who don't trade actually don't see a change in their welfare. Which already suggests, if you want to think about taxation of this redistribution from asset price changes, that it has to be based on the trades, right? You should tax the sellers. You should not tax the people who don't trade. You might want to subsidize the buyers. So a wealth tax doesn't achieve that. It's not conditional on any of your trading behavior. But in fact, the system that we have, a realization-based capital gains tax, does it, at least partly, because it only taxes the people who sell, which is exactly the right thing. So what we argue in this work with my co-authors, Mark Aguiar and Ben Moll, is that a realization-based tax is actually the right tool in that context. And of course, if dividends change, then you should also have a dividend tax or a cash flow tax. So if the stock doesn't pay $100, but if that changes, to something else, then you should combine it with the dividend tax. So let me conclude. My summary of this kind of normative approach is that wealth or accrual-based capital gains taxes, in the spirit of Haig-Simons, really risk mistargeting if you tax wealth and you have both this shifted labor income problem and you have asset price changes that actually drive these capital gains. You might tax the wrong people using a wealth tax. You might by chance tax the right people, but it's only by chance. There's a second problem with this, which I didn't have time to talk about today, but we'll actually talk about tomorrow in the research seminar at the department, which is that if you do that, you also have another effect, which is you have a dilution effect on the ownership of startup founders. If you have a startup, you don't have liquidity as a founder, but you start having to pay tax like a wealth tax or an accrual-based tax, then you might have to constantly kind of sell shares to be able to pay these taxes, and you lose ownership in your own company, which might have very bad effects if you need some minimum amount of ownership in your firm to even realize your business ideas. By contrast, capital gains taxes on realization are widespread. That's what we have in most countries, and they are normatively justified in many cases. So I didn't coordinate with this on this with Kjetil, but that's kind of my bottom line, that a modest approach for reforming the system is to just get rid of, keep the current system of realization-based capital gains taxes, but get rid of step-up in basis. And the fact that we agree on that is actually, I think, quite indicative of the consensus we have among economists that step-up is just a bad idea. It's also a bit of an outlier. Most other countries have, like, Norway got rid of it. Germany has a carryover system where if you inherit some assets, you just have to pay, and you sell them, you just have to pay the capital gains tax on the full gain since the original basis, not since inheritance. And that would also deal with these buy, borrow, die strategies that we see now, that people try to never realize capital gains, just hold on to their stock, and then finance their consumption by borrowing against these unrealized gains to completely avoid the tax. Thank you.
Well, thank you very much, Kjetil. So now I'd like to open up to your questions. And what we're going to do is that the handsome man here with the mustache is going to hold the microphone and come on down to, okay, good, thanks. And then just come on down to where he is and ask your question. We already see someone getting up to ask a question. So let's, instead of my question, let's go with yours, sir, please.
Thank you. I'm really happy to be here with this batch of economists. 2 hours ago, I was sitting at a meeting of the Minnesota Public Utilities Commission. They were debating whether to allow a subsidiary of BlackRock to buy Minnesota Power. That's my electrical provider up on the range. And I guess my question is, I have stock in Minnesota Power, bought it 40 years ago for retirement. And so what I'm working up to is, if I get bought out, I get dividends every year on that stock pretty faithfully, and I pay taxes to the state of Minnesota. How does the state of Minnesota replace that income stream when my stock disappears under the BlackRock umbrella? Thank you.
You're the Minnesotan.
So I didn't fully understand the question, but I think what you're asking is if the state of Minnesota owns a utility company and they sell it to BlackRock, that's not. But I mean, if BlackRock buys the shares of the owners of the company, the owners are going to get cash and would presumably buy other stocks. So I don't think it's going to affect. That's it's going to affect. Okay, so Minnesota is one of the few states that has a state level corporate tax, and also there's also state level taxes on dividends in Minnesota. Dividends are taxed like income. So when BlackRock get that income, it's that the tax revenue from Minnesota is going to fall. But the question is what the old owners, what they do with the money if they buy new stocks. I don't think the situation won't be affected. But
Pay the capital gain. Come down and this way people who are online can hear the question.
Thank you. I want to take this opportunity to sort of circle back to a couple of things you guys already mentioned. I mean, the way I see it is that there are three practical difficulties with the wealth tax, two of which you guys mentioned. A lot of wealth in the US is private. I'm thinking about accountants, lawyers. Their book value is nearly zero, and there is no consensus on as Florian mentioned, what is the tax base here? The value of your customer list is the value of your own effort. So it seems like it's sort of it's not obvious how to clearly define a tax base. The second practical issue I see is a lot of small businesses, they may not have cash to pay that wealth tax, even though they might be valuable in some other metric. And the third, to me, is the most critical one. It is not obvious if a wealth tax, federal wealth tax, is constitutional. There is a very good argument to be made that that's a direct tax which will trigger apportionment, and Supreme Court hasn't really decided on that. It might come up, but it might just be unconstitutional. So it seems like we can discuss a lot about theory of taxation, but these practical difficulties seem unsurmountable to me.
So great points, Anmol. So it's true, the Supreme Court has so far, this would also apply the tax on accrued capital gains, by the way, which the Supreme Court has never ruled whether unrealized capital gains constitute income. It sort of dodged the question last time they had ruled on the repatriation things, where they explicitly that they don't want to sort of make a decision on that fundamental question. But I want to emphasize that this is not just a US debate, right? So in France, in France, there's also an issue about constitutionality, but there's opposite decision. For instance, a few months ago, the Netherlands used to have what essentially is a wealth tax. It's a notional capital income tax. So you have to pay a capital income tax at a notional rate of return, which is just fixed depending on asset classes. And the Supreme Court also just ruled that unconstitutional, and they're thinking about introducing a capital gains tax on actual unrealized gains now. So different countries have these different legal problems, and often as economists we try to step back from that and think about optimal tax system a bit unconstrained from what might be legal, the legal constraints in different countries.
I agree with that. But I want to say, you made a very good point about risk. So if you pay, say, a corporate tax, or if you have a closely held firm and so-called S corporation, and you pay you just pay the returns go as a pass to yourself and pay income tax on it. It's as if the tax system shares the risk Because if you make a lot of profits, you pay a lot of taxes, but then you also have a lot of money. If you lose money, you actually have negative taxes. So the government kind of shares the risk somehow. A wealth tax is brutal. Pay it no matter. So it's as if a tax is wealth tax is kind of like debt. That doesn't necessarily make it bad. It just means that entrepreneurs are going to take less risk. That might be bad. And in fact, that's the discussion in Norway is centered around that. So especially firms in rural areas are worried that they are going to be somehow hurt more because the booming firms, surprise, surprise, happen to be in the cities.
On the liquidity briefly, Anmol, you said, some people might have illiquid forms of wealth and no corresponding income. It's interesting. Often people ask me, how does this work in Switzerland? Don't you have a lot of these cases where actually you'd have to pay wealth tax, but people can't pay it? And many cantons, not all, have these provisions that essentially cap the wealth tax in these cases where you actually have no income. So you might have to pay 1.1% wealth tax in Geneva, but then there's this cap that if you don't have this income, then this gets actually lowered. And if you look at the administrative data, how many people are at these caps, so those would be these kind of poor, income poor wealth millionaires that would be supposed to be paying wealth tax. If you look at the admin data, how many people are affected by this, it is a handful of people. So it's surprisingly few people that actually have this problem. Now, the wealth tax is not very high in most Swiss cantons, but just from the Swiss perspective, it doesn't seem like a particularly widespread issue that people just don't have this corresponding income.
So I'm a little bit curious. I know the conversation around taxing millionaires and billionaires in the United States is like rife with animosity. And I don't necessarily trust that if we were to find the best tax policy and put it into place, that people like Jeff Bezos wouldn't figure out a way around it. So I'm curious if you would be willing to discuss if there were to be a tax on unrealized gains, there be any incentive for people like Jeff Bezos to maybe of their stock before a certain tax deadline or et cetera? Like, what are the ulterior incentives on taxing unrealized gains?
I mean, especially if you make these proposals very progressive and you really target the richest people, people above 100 million, like that's the cutoff currently discussed in France, then of course you also hit the people with the strongest incentives and the best means to come up with ways of avoiding that tax. That's why it's so hard to predict. There's all this discussion right now in France. What would actually be even the revenue from the Zuckman tax proposal, right? So you can plug in some standard estimates like from the papers that Kjetil mentioned that have estimated behavioral responses to wealth taxes. But that is entirely speculative to what degree that would actually extrapolate to this very small subset of extremely rich people. So presumably these elasticities would be much higher in practice, and that's why you get these very different revenue estimates, and some people even estimate that the revenues might be close to zero. This is both migration, but also these different constructions of ways of avoiding the tax. I think if you want to sort of do it, you have to do it the Swiss way, which is basically no loopholes. It's a super broad base. Everything is included. You can only avoid it by leaving the canton or the country, but you can sort of restructure your wealth in a way that really avoids it. There's already discussion in France right now because of these concerns about startups, for instance, to exclude business wealth from the Zuckman tax. That would be a disaster because that's exactly what Spain did with its wealth tax. And when they introduced this, like the revenue immediately collapsed and all the wealth was shifted into somehow business wealth, especially if you allow rich people to do that. So it would have to be a very broad-based tax, and then that affects these elasticities. These elasticities are not, you know, laws of nature, right? They're a function of your enforcement and, in fact, how you design the tax base. And you can lower these elasticities by making the base very broad. But that would be the only option, I think, to make it a decent source of revenue.
Yeah, it's hard to prevent. We really have a lot of resources to invest in trying to avoid the tax. It's hard to fully capture it. I mean, one alternative way of doing it, it would be, imagine you tax firms differently. So if the problem is that people park the value in the firm, perhaps you could, instead of taxing wealth at the household wealth, you might tax, say, firm cash. So the firm could, if the firm has some profits, if they use it for investment, it's not taxed. But if they just withhold it as cash, it would be taxed. The one way to mitigate it, but it's not. I don't think we have a good solution.
On special economy. Suppose we wanted to tax the 400 richest people, their consumption, and we wanted to do it in a way that they like. It'd be hard to get much out of Elon Musk because he sleeps on people's couches. I don't think he consumes that much. Jeff Bezos just did a $7 billion wedding. I made that up, but it's consumption. What are I don't know what the thought is on the hardest to get around consumption taxes. You would have to worry about payments in kind by a firm like the private jet. Is there work on getting around tax avoidance for consumption taxes at the very top?
I actually think that doing it through consumption, and many of our sort of classical models, the consumption tax would be equivalent, you know, to taxing wealth. And so you could say, you know, ultimately the welfare effects rely on consumption, so that's what we should tax. But I think in practice, actually doing a progressive consumption tax, you know, which is progressive in the sense that higher consumption actually gets taxed more, is actually quite tricky. Because if you think about part of the consumption of these guys is what's currently treated even as tax deductible. So you put your money in a foundation and you do I mean, a lot of what they're doing through their foundations is great stuff, but part of it is consumption. In the sense that if I give money to the University of Minnesota and then my name is on the building and I get invited to fancy dinners with smart professors, that is currently treated as a tax deductible charitable donation, but I think it's part of the consumption. So you'd have to think about all these things, you know, when Bill Gates puts all his money in his foundation, what of it is just consumption, or if he's curing malaria, then maybe that's not his consumption, it's actually a great thing and we shouldn't tax it. But if Elon Musk is putting it in SpaceX and it's going to Mars, that's just, it's consumption. I don't know, like it becomes very conceptually difficult to decide what exactly is the consumption there. And if you don't do that, if you just look at literally how much they eat and spend on their wedding, then this is probably not capturing the full degree of consumption that they're actually enjoying.
Can I just give a quick answer and say, there is another form of consumption, which I think there has been more debate, more thinking in tax authorities about how to get that, namely private consumption through the firm. How about if the firm has a bunch of withheld earnings? How about if we have a private jet and you fly to Chicago to see, I don't know, the White Sox or something, whatever, who's playing there? That's a way to not only get consumption, but also to avoid the dividend tax. So tax authorities in Norway thought about many things, including that. So what they've done, what they did 2 years ago, or just as the number of ultra-rich people started to move in droves to Switzerland, part of the reason was that they cracked down on that. So firms, there was a special corporate jet tax for firms. So anyway.
Hi, thank you. I just wanted to ask, what is the role of like private debt in all this scheme? Because, for example, Trump was criticized because for many years he didn't pay any taxes because he was indebted, right? Or maybe me, Elon Musk, whatever, right? Can borrow money using my stock as a collateral, right? So in the books, I'm in debt, or I have like negative income in a way, right? So is that a possible way to avoid many of these structures?
So I wasn't sufficiently clear, but the debt is exactly how to do it. So imagine the plan is, imagine you're my son. I've made a lot of money in a firm. I want to avoid taxes. I don't pay dividends. I just withhold all the earnings in the firm. But I like to consume. How do I do that? Well, I borrow. I go to the bank and say, I like to borrow. And the firm bank says, how can you guarantee? Well, I give you collateral in the stocks in the firm. So I live off my debt. So when I die, I give to you the firm and the debt. So it's precisely to private debt are able to involve in that scheme.
So it's what I mentioned at the very end. It's this buy, borrow, die strategy that also Elon Musk, for instance, is doing. You never realize your capital gains. You finance your consumption out of borrowing against the unrealized gains. Now, there have been proposals recently to tax that kind of borrowing. So to say, okay, to close that loophole, you just have to pay a tax when you take the loan. It's trying again, come back to a consumption tax, basically, but targeting this kind of borrowing. I think this is also a terrible idea, because then you'd have to, essentially what these proposals then have to distinguish is that kind of borrowing you want to tax, but regular borrowing, if somebody has a mortgage against the house, we don't want to tax that. So like, what kind of rules are you going to come up with to distinguish that? Now, if we just got rid of step up in basis, it would already basically prevent that, close that buy, borrow, die loophole. Because if you think about Elon Musk is borrowing against his unrealized Tesla stock gains. At some point, I think that's partly missed in the public debate about that. At some point, he will have to repay that debt. Now, how do you repay the debt? Well, either you cut into your consumption, then you're not really benefiting from the appreciation of your Tesla stock, or you just sell Tesla stock, in which case, if you have a realization-based capital gains tax, you will have to pay taxes at that point. Now, the only problem is if you never realize you bequeath this, then you might completely avoid the tax. But if you eliminate step up in basis, at some point, all debt will have to be repaid. At some point, people will, even if it's the heirs, they will have to sell these stocks to repay the debt. And at that point, if we're patient enough, we always collect the tax revenue on it. So getting rid of step up is kind of sufficient, unless you sort of go into political economy reasons why we're not patient and we want to get the revenue earlier already rather than later, which has to do with these, maybe changing administrations, and at some point there will be a low tax administration, and but now you want to make sure that you get the revenue already now. But apart from that, I think just getting rid of step up also deals with this borrowing issue.
Okay, so wealth has a small advantage that it doesn't suffer from something that could be easily fixed, but somehow never gets fixed about capital gains. That we tax nominal capital gains. And so, you know, we had about of 15% inflation. The government claims that 15% of our assets are now gains just because it's pure paper. What's on that? That's just fix the nominal issue, or?
Yeah, I think it should be on the real gains. Absolutely. Now, you could argue that the fact that we tax the nominal gains and we ignore inflation sort of undoes part of the tax advantage that we otherwise currently have because the rate is lower. So in that sense, maybe it's not terrible. But yeah, clearly from an optimal tax perspective, it should be the real gains that we're taxing.
I agree, but any kind of change is a heavy lift. So do you think there's going to be a huge increase? Is 7, 8, 9% inflation on the horizon? I don't think so. So there are many problems to fix out there. Is that what you like to spend, I don't know, 5 years of legislative energy on? I don't think so.
I also agree with that. So it's interesting, you know, when we said we both agree on getting rid of step up in basis, I think most economists, or public finance economists, agree on step up in basis. In fact, from what I know about the history of step up in basis, it was never a conscious legislative decision to have this rule. It was purely kind of within the IRS, it was a kind of organizational rule that when they had these first cases of capital gains that were bequeathed, they were just wondering, how should we treat that? What should we use as the basis? And was it kind of like an internal administrative rule that, oh, well, let's just go back to the basis at the time the guy inherited the asset. And then later Congress legislated that, but it's just pure coincidence, I think, that this happened. And in fact, the Biden administration tried to get rid of it, as you know, and couldn't get it through Congress because of the family farms argument, which killed it politically, which illustrates how hard it is to even change these small things where I think there should be kind of consensus. It's surprisingly hard.
Well, thank you very much. This has been wonderful. This has been a great discussion and really appreciate you taking your time. So thank you, but I also want to thank the staff and the student workers who assisted with the event tonight. And I encourage you to visit the Heller-Hurwicz Economics Institute website for more economic research and policy briefs, including links to the episode of the Office Hours podcast. You're going to really like it. This conversation will be made available as a special episode of the Office Hours podcast, so watch for that. And then please join us for an atrium, for a reception in the atrium. And thanks to all of you for joining us tonight.